The year is 2025 and the financial world watches with bated breath. Tokenization, the process of transforming real-world assets into digital tokens on a blockchain, promises a future of faster transactions, greater transparency, and wider investment access. But a critical question looms large. Will the heavy hand of regulation crush this burgeoning technology underfoot? Or can it strike a balance that fosters innovation while safeguarding market integrity? The answer, as with most things in the world of finance, is far from simple. Across the globe, regulators are grappling with how to approach this transformative technology. Some see tokenization as a natural evolution of existing financial markets, while others view it as a radical departure requiring entirely new rulebooks. This divergence of opinions has led to a complex and often confusing patchwork of regulations, creating both opportunities and challenges for businesses and investors alike. The United States, the European Union, and the Asia-Pacific region have emerged as key players in the global tokenization landscape, each with its own approach to regulation. The US, true to its entrepreneurial spirit, has taken a more fragmented approach, with different regulatory bodies vying for influence. Meanwhile, the European Union is pushing for a more unified framework with its landmark markets in crypto assets, or MiCA regulation. In Asia, a dynamic mix of innovation hubs and cautious regulators has created a region brimming with potential but shrouded in uncertainty. This regulatory fragmentation presents a significant challenge for businesses operating in the tokenization space. Navigating the complex web of rules and regulations across multiple jurisdictions can be a costly and time-consuming endeavor, particularly for startups with limited resources. Moreover, the lack of regulatory clarity can stifle innovation, as businesses may be hesitant to invest in a technology that could be subject to sudden and unpredictable changes in the regulatory landscape. In the United States, the Securities and Exchange Commission, or SEC, has emerged as a key player in the tokenization arena. Under the leadership of Chair Gary Gensler, the SEC has taken a more proactive approach to regulating digital assets, including those related to tokenization. The SEC has emphasized the need to protect investors from fraud and manipulation, arguing that many tokenized assets fall under existing securities laws. One significant development in the U.S. regulatory landscape is the introduction of legislation like the Token Taxonomy Act, which aims to provide much-needed clarity on the definition of digital assets and establish a regulatory framework for tokenized securities. This legislation, if passed, could pave the way for greater institutional adoption of tokenization by providing a clear set of rules for market participants to follow. Across the Atlantic, the European Union has taken a more proactive and harmonized approach to regulating tokenization. The EU's landmark markets in crypto assets, or MiCA regulation, expected to come into full effect in the coming years, aims to create a single, comprehensive framework for crypto assets, including those related to tokenization. MiCA introduces several key provisions relevant to tokenization. It establishes a clear legal framework for issuing and trading crypto assets, including tokenized securities. MiCA also introduces requirements for crypto asset service providers, such as exchanges and custodians, to obtain authorization and operate within the EU. This harmonized approach aims to foster innovation and competition while ensuring investor protection and market integrity across the bloc.